Hey everyone, and welcome back to the channel, your go-to source for understanding the mechanics behind how to borrow stocks and potential short squeezes. Today, we're diving deep into a fascinating ticker that recently popped up on our screener, DSY, or Big Tree Cloud Holdings Limited. This company is showing some truly eye-watering cost to borrow fees, and we're going to break down exactly what that means. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's get straight into Big Tree Cloud Holdings Limited, ticker DSY. This company operates in the consumer defensive sector, specifically within household and personal products. DSY manufactures and sells personal care items, including sanitary napkins, panty liners, and sanitary pants, along with offering OEM/ODM services under its Big Tree Cloud and Yellowyoda brand names. It's a relatively small company with a market capitalization of just $16.02 million. Show DSY logo/info. Now for some recent price action on DSY. To date, the stock is down 1.42%. Over the last 5 trading days, it's seen a sharper decline of 21.41%. However, zooming out a bit, DSY has surged over the last 30 days, showing an impressive gain of 79.53%. This kind of volatility is often something to watch in these smaller, highly shorted names. Volume-wise, things are notably quiet right now. Today's volume for DSY is only 14,478 shares. That's drastically lower than its 30-day average volume of 5,784,555 shares, meaning its relative volume is sitting around 0 times its average. This extremely low trading activity is a critical data point we'll touch on again later. What is cost to borrow and why it matters? So, what exactly is cost to borrow, often abbreviated as CTB, and why is it so important when we talk about short squeezes? Simply put, the cost to borrow is the annualized interest rate that short sellers pay to borrow shares of a company. When you want to short a stock, you first need to borrow shares from a broker. That broker, in turn, has to get those shares from an existing shareholder. Just like borrowing money, there's a fee involved in interest rate, and that's the cost to borrow. Visual, animated explanation of CTB. This fee is dynamic. It changes based on the supply of available shares to borrow and the demand from short sellers. When a stock is highly sought after by short sellers and the available shares to lend are scarce, a cost to borrow can skyrocket. And yes, it can absolutely exceed 100% annualized. Think of it like a loan with an extremely high APR. Short sellers are essentially paying a premium to maintain their bearish position. A high cost to borrow acts like a ticking clock for short sellers, increasing the pressure on them to close their positions, especially if the stock price starts to move against them. Why the stock is hard to borrow right now. Now let's talk about why Big Tree Cloud Holdings, DSY, has appeared on our hard-to-borrow screener. The numbers here are truly striking. DSY currently has an annualized cost-to-borrow fee of a staggering 701.7%. Show CTB number prominently, that's not a typo, over 700%. This extremely high fee tells us a few things. There is immense demand from short sellers who want to bet against DSY, and simultaneously, there's an incredibly limited supply of DSY shares available for them to borrow. With an estimated float of just 1.3 million shares, DSY is a relatively small and illiquid stock. While the exact number of shares currently available to borrow is unknown, at 701.7%, CTB is screaming that borrowable shares are exceptionally scarce. This kind of environment is exactly what piques the interest of traders looking for short squeeze potential, as it implies significant pressure on short sellers. Squeeze mechanics explained. So, what is a short squeeze? It's a rapid increase in a stock's price, often forcing short sellers to buy back shares to limit their losses. Here's how it works. A short seller borrows shares and sells them, hoping the price will drop so they can buy them back at a lower price, return them to the lender, and pocket the difference. But what if the price goes up instead? Animated chart showing price rising, shorts buying. If the stock price rises significantly, or if the cost to borrow becomes prohibitively expensive, short sellers face mounting losses and fees. They might be forced to cover their positions, which means buying back the stock in the open market to return the borrowed shares. This forced buying creates additional demand for the stock, driving the price up even further, which then triggers more short sellers to cover, creating a cascade effect to squeeze. For DSY, with its 701.7% cost to borrow and small float, the ingredients for such a scenario are present. However, it's crucial to understand that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have very strong conviction in their bearish thesis and are willing to pay a premium to stay short. Our internal composite squeeze score for DSY, which considers multiple factors like CTB, volume, and technical setup, currently sits at 41.1 out of 100. This indicates some elements are aligned, but it's not screaming imminent squeeze signal. Dilution risk check. Another critical factor to consider when evaluating a potential short squeeze candidate is dilution risk. Dilution occurs when a company issues new shares, which increases the total number of outstanding shares. This can reduce the value of existing shares and often give short sellers an easier path to cover their positions, as there are now more shares available in the market. Visual, animated shares increasing. Our checks for DSY show no recent dilutive SEC filings such as SMINUS1, SMINUS3, or 424B found in the last 90 days. This is a positive sign for any potential squeeze thesis, as it means the company hasn't recently flooded the market with new shares that could easily be used by shorts to cover or otherwise depress the stock price. Furthermore, we found no recent reverse split for DSY in our look-back window, which can sometimes be a precursor to further dilution or problematic price action. The absence of these factors removes one potential headwind for DSY. Once again, a quick reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you watch for if you're interested in DSY and its hard-to-borrow status? The current ultra-low volume of 14,478 shares today, compared to its 30-day average of over 5.7 million, is a key metric. A sudden and sustained surge in trading volume, accompanied by significant upward price movement, could signal increasing buying pressure. This would be a departure from the current quiet trading and might indicate short sellers beginning to feel the heat. Show volume bar chart. You'd also want to keep an eye on the cost to borrow itself. While it's already incredibly high at 701.7%, any further increases or a significant decrease in reported shares available to borrow could intensify the pressure. Monitoring price action, especially if it breaks key resistance levels, would also be crucial. Remember, for a squeeze to truly ignite, you typically need both high short interest implied by high CTB and a catalyst that sparks buying pressure. Victory Cloud Holdings Limited (DSY) presents a fascinating case with its astronomical 701.7% cost to borrow. This fee highlights extreme demand from short sellers coupled with very limited share supply, all within a small float, consumer defensive stock. While the ingredients are certainly present for a potential squeeze scenario, particularly with no recent dilution risk, the current low volume and the overall score of 41.1 suggests it's a situation to watch cautiously, not a guaranteed rocket. Understanding these mechanics, rather than chasing quick gains, is the true value of education on hard-to-borrow stocks. If you found this breakdown helpful, please hit that like button, subscribe to the channel for more deep dives, and let us know in the comments what other hard-to-borrow stocks you'd like us to analyze next. Thanks for watching, and we'll see you in the next video.